The secret in your grocery cart. You already know which stocks could make you rich, not because you're an analyst, not because you've got a Bloomberg terminal glowing in your apartment at 2 a.m., but because you just added them to your shopping cart. The truth? The most powerful investment strategy isn't locked in some Wall Street algorithm. It's hiding in plain sight. Your daily routine, your breakfast brand, the phone in your hand, they're not just expenses. They're clues. They're a portfolio waiting to happen. And yet, while we scroll through Reddit for the next meme stock, the real wealth quietly walks past us in the form of a delivery truck with a smiley arrow on its side. That's the paradox. We chase what we don't understand and ignore what we already trust. Here's the stat that should punch through the noise. If you had invested $1,000 in Apple in 2007, not because of charts, but because you simply loved your iPhone, you'd be sitting on more than $60,000 today. And you wouldn't have needed a financial degree. You just need to notice your own habits. In this video, we're pulling back the curtain on a strategy so elegant, it feels almost like cheating, inspired by the ideas of Edward W. Ryan, but reimagined, rewritten, and reshaped into something far deeper than a how-to guide. This isn't just about stock picking. It's about recognizing that wealth doesn't come from predicting the future. It comes from paying attention to the present. And the good news? You've already got the map. This isn't theory. It's not speculation. It's a revolution of awareness. So if you've ever felt like investing is too complicated or too risky, this might be the moment that changes everything. Because the fortune you've been looking for, it's already sitting in your grocery cart. Let's unpack it. Chapter 1. The cart that knows your future. Imagine this. A man walks through a grocery store in 2008, annoyed that his daughter only eats Cheerios and refuses anything else. He sighs, tosses the yellow box into the cart, and moves on. That same man passes the Apple section at the mall, where he just bought his second iPhone, Starbucks cup in one hand, Costco membership card in the other. He never thinks twice about any of it. He's a consumer, nothing more. Now, let's rewind. What if that man, instead of just buying, had started buying shares of the same companies he already supported? What if each Cheerios box had been a reminder to invest in General Mills? Each iPhone a nudge toward Apple stock? That man didn't need inside info. He didn't need charts, mentors, or money he didn't have. All he needed was this one shift in thinking. What if my daily life is a crystal ball? Here's the idea. Your cart, your phone, your fridge, they're not random. They're data, emotional data, economic footprints, and in those footprints lie some of the greatest investing opportunities you'll ever have access to. But most people miss them because they think investing is about finding something new, something technical, something outside themselves. It's not. Think about it. You already trust certain companies. You already pay them every week. They're part of your identity. From the shoes you wear to the toothpaste you buy, you're telling the market what matters to you. That trust, it's more valuable than any analyst's prediction. Let me tell you the story of Carla, a 26-year-old nurse from Ohio. She's not into stocks, but during the pandemic, she started ordering everything online, from Clorox wipes to Peloton classes. One day, her boyfriend joked, "You basically fund Amazon's entire existence." Something clicked. Instead of just laughing, she went to her Robinhood app and bought 2 shares of Amazon at $98. She didn't do deep research, she just followed her habit trail. 2 years later, her position was worth over $3,500. That's not magic, that's pattern recognition. What the author really wants you to understand, beneath all the simplicity, is this. You are already giving the market your best picks. You just haven't been listening. You are the data. You are the trend. The market is simply reflecting what you already believe in. So, pause and look at your life. What apps do you open before breakfast? What brands live in your fridge, your closet, your garage? What companies would you cry over if they shut down tomorrow? Because those are your signals, not some Reddit trend, not the talking head screaming on TV. You. Have you ever thought, I'm too late, the stock already went up? What if instead, you realized you're always early, because you're already using the product before Wall Street catches on? The edge you've been searching for isn't in the charts, it's in your choices. But this is just the tip of the iceberg, because noticing your habits is one thing, turning them into a system, that's where the transformation begins. Chapter 2, The Life List. It starts with a walk, not on Wall Street, but through your own life. Imagine walking from your bedroom to your kitchen and writing down every brand you see along the way. From the Samsung logo glowing on your TV to the Colgate in your bathroom cabinet to the Nike slides near the door, you just built the first draft of what I call the life list. This isn't a stock screener, it's a mirror, a deeply personal inventory of companies you've already chosen with your wallet again and again. You didn't read their earnings report, you didn't consult a financial advisor, but you believed in them anyway because you trust them, because they work, because somewhere along the line, they became part of you. Now imagine turning that trust into ownership. Every time you buy from them, they pay you back. That's what the life list unlocks. It flips the power dynamic. You're no longer just a consumer, you're a partner. Let me tell you about Jason. He's a high school teacher from Oregon. In 2020, during quarantine, he noticed something strange. His bank account kept shrinking, but 5 companies kept showing up on his credit card bill: Netflix, Amazon, Domino's, Zoom, and Peloton. He laughed at first. "I'm a cliché," he said. But then he did something brilliant. He wrote them down. That was his life list. Within 2 weeks, he invested $200 in each. Over the next 18 months, that $1,000 turned into 1680s. Not millions, but a 68% gain just by being self-aware. Here's the deeper truth. The life list isn't just about stocks. It's about attention. The most valuable currency you own is your attention, and these companies already have it. So why not turn that attention into appreciation in the financial sense? What Edward Ryan hints at, and what we're making explicit here, is that investing doesn't start with CNBC. It starts with self-observation. If you're willing to track where your money naturally goes, you'll begin to see something miraculous. The market isn't random. It's responsive. It follows behavior. Your behavior. So I challenge you now. Grab a notebook or open your notes app. Walk through your digital day. What websites do you visit? What platforms do you trust? What do you spend money on when you're not even thinking? Make that list. That's your compass. That's your unfair advantage. Have you ever told yourself, "I don't know what to invest in"? What if you stopped looking out and looked in? What if the answer wasn't in someone's tweet, but in your grocery receipt? Because once you've built your life list, it's no longer a question of, "What should I buy?" The only question left is, "When?" And to answer that, we'll need a foundation far stronger than impulse. We'll need the core philosophy behind this entire strategy: simplicity. Chapter 3. The Foundation of Simplicity. A man once asked Warren Buffett how he became one of the richest people in the world. Buffett smiled and said, "We just try to be fearful when others are greedy, and greedy when others are fearful." But here's what he didn't say aloud. He keeps it simple. While the world dances with chaos, Buffett sits quietly in his fortress of simplicity, collecting wealth like clockwork. Most investors don't lose because they pick the wrong stock. They lose because they build a strategy so complicated, they can't follow it. Simplicity isn't the absence of intelligence. It's the proof of mastery. Imagine investing like making breakfast. The amateur tries to create a 7-layer gourmet omelet every morning, burning eggs and running late. The master? He's been eating oatmeal for 20 years, healthy, focused, thriving. In investing, oatmeal wins every time. There's a story I love about 19-year-old Emily, who was inspired by YouTube finance videos. She dove into options trading, crypto derivatives, margin accounts. She lost $3,400 in 3 weeks. Devastated, she deleted all her trading apps, except one. Inside that app, she started with a new plan. Just invest $200 a month into the companies on her life list. Starbucks, Costco, Apple. Fast forward 2 years, and her account had quietly grown to $7,800. No stress, no noise, just slow, steady simplicity. What Edward Ryan tried to whisper in his book, what most people miss, is that investing is not a game of intellect. It's a game of endurance. And endurance is only possible if the system is simple enough to follow when you're tired, scared, or tempted. Here's what happens when your strategy is too complex. You hesitate, you second guess, you over-research, you miss entries, you exit too early. You become a victim of your own intellect. But when your strategy is built on clarity, on rules that don't change, you become immune to the storm. So here's a question. Have you ever said, "I'll start investing once I understand more"? That mindset is a trap. You don't need to understand everything. You just need to understand yourself. Simplicity isn't the absence of depth, it's the presence of focus. And once you're committed to simplicity, There's only one variable left to master: time. Because the truth is, even the simplest strategy is worthless if you quit too soon. But what if time wasn't your enemy? What if it was your greatest ally? Chapter 4: Time in, not timing. Every beginner investor asks the same question: is now a good time to buy? But that's the wrong question. The real secret of wealth isn't found in timing the market. It's in time in the market. Not jumping in and out like a nervous guest at a party, but showing up early, staying late, and letting compounding do what it does best: silently, slowly, relentlessly multiply. Let me tell you about Marcos. In 2010, he bought $1,000 of Johnson & Johnson stock. He meant to hold it for a year. Life happened. He forgot the password to his brokerage account. 11 years later, he finally accessed it. His $1,000 had become over $3,700. Dividends reinvested. No trading, no rebalancing, just time. In contrast, his friend Kyle tried day trading during the same decade. He made $6,000, lost $8,000, made $500, lost $1,200. Every gain was followed by a loss, every strategy undone by the next market twitch. At the end of 10 years, Kyle was exhausted and broke. This is the silent killer of modern investing: impatience. Our brains have been rewired by dopamine hits. We expect our portfolios to behave like TikTok, for every move to matter, for every dip to be a sign, for every chart to tell a story. But real investing is like gardening. You plant the seed, water it, and wait. Edward Ryan didn't shout this truth, but it echoes behind every page of his strategy. Wealth isn't built on moments, it's built on duration. And the only investors who win consistently are the ones who let time, not timing, do the heavy lifting. So here's the uncomfortable mirror. Have you ever exited an investment too early just because it didn't do something fast enough? Have you ever chased a fast-moving stock because it looked exciting? These aren't investment decisions. They're emotional reactions. And emotions have no loyalty to your goals. Instead, try this. Next time you're tempted to trade, ask yourself, am I reacting to the market or to my own impatience? Because once you understand the value of time, you stop looking for the perfect moment and start building the perfect habit. And now that you're grounded in time, the next step is learning how to filter the right stocks from your life list without turning into a spreadsheet zombie. Chapter 5: Don't outsmart yourself. It's a cruel paradox. The smarter we get, the dumber our decisions become. In investing, intelligence doesn't always lead to better results. It often leads to overthinking, paralysis, or worse, confidence without clarity. You don't lose money because you're uninformed. You lose it because you try too hard to be clever. Let me introduce you to Darren, MBA, top of his class, obsessed with financial modeling. He built elaborate spreadsheets with color-coded macros and 6-tab projections. He back-tested every stock in his life list for a decade. And then, he never bought anything. He was too busy optimizing. While Darren ran simulations, his college roommate, Lisa, just bought shares of Costco and held them. 5 years later, her portfolio was up 160%. Darren was still tweaking formulas. Here's the lesson. Complexity feeds the ego. Simplicity feeds the wallet. We've been taught to believe that the more effort we put into something, the better the outcome. But in the market, more effort often creates more noise, more justification, more internal arguments. And the result? You trade less from conviction and more from confusion. Edward Ryan's method is simple on purpose, because simplicity removes excuses. You don't get lost in, should I buy now or later? Or, is the debt ratio optimal? You ask, do I believe in this company based on my own usage? Is it profitable? Does it have manageable debt? 3 questions. That's it. Anything beyond that is self-sabotage disguised as diligence. Think of your brain like a courtroom. Every time you analyze, you're calling more witnesses, adding more charts, more voices. And at some point, the judge, you, can't even hear the case anymore, so you delay, you hesitate. Or worse, you panic buy something unrelated just to feel in control again. Here's a challenge. Can you let go of your need to be right and instead focus on being consistent? Because real investing wisdom isn't found in your IQ. It's found in your behavior, your willingness to trust a system, even when it feels boring, especially when it feels boring. It's time to stop outsmarting yourself. The market doesn't reward brilliance, it rewards discipline. And the next step in discipline is having a repeatable, minimal effort process to evaluate your life list companies. Which brings us to the Scout's secret. Chapter 6. Screen like a scout. A scout doesn't look for perfection. A scout looks for readiness. Is the soil firm? Is the path clear? Are the conditions good enough to proceed? That's all. And in the world of investing, that same mindset can make the difference between paralysis and progress. You already have your life list. Now, how do you filter it? How do you know which companies are strong enough to invest in without falling into another 20-tab spreadsheet rabbit hole? Here's the Scout's rule. 3 signals, no more. Is the company consistently profitable over the last 5 years? Does it have manageable debt? Does it reward shareholders with dividends or buybacks? That's it. These 3 signals, profit, prudence, and payout, are the heartbeat of a company worth trusting. And unlike hype metrics, they don't lie. Let's go back to Carla from earlier, the nurse who bought Amazon. After that first win, she wanted a system. She didn't want to guess anymore, so she started using this 3-question filter every 3 months, sitting down with her life list and pulling up free data from Yahoo Finance. In less than an hour, she could tell which companies were still healthy and which ones had cracked. Did she miss some winners? Sure, but she avoided landmines. And over time, her portfolio didn't just grow, it stabilized. Like a scout, she learned to sense the terrain. What Edward Ryan implies, but what we'll make explicit, is that investing isn't about complexity. It's about consistency. Your screening process shouldn't change with market moods. It should stay so simple that you can do it tired, distracted, or even heartbroken, and still make the right choice. Because the market rewards systems that endure more than ones that impress. Let's take a real example. In 2025, Celsius Energy is on fire. Everyone's talking about it. The drinks are viral, but when you apply the 3-signal screen, profitable, yes. Debt, manageable. Shareholder rewards, not yet. That pause might save you, or at least guide your position size. Meanwhile, Costco, Apple, and Johnson & Johnson quietly pass all 3, again. Quiet wins are the loudest over time. So ask yourself, do you have a filter that you trust? Not one you borrowed, not one you fear you're misusing. One that you can apply again and again with clarity. Because the purpose of screening is not to eliminate doubt. It's to eliminate indecision. And once you have your process, there's one more trap you must avoid. A trap that's dressed like a deal. A number so seductive it's fooled even the best investors alive. The infamous P/E ratio. Chapter 7. The P/E ratio trap. It's on every finance page. Every investor mentions it. The P/E ratio, price divided by earnings, is supposed to be your shortcut to knowing if a stock is cheap or expensive. But here's the truth most won't tell you. This shortcut has led more people off a cliff than into profit. The P/E ratio is like a dating profile. It might tell you something about the person's current photo, but nothing about their character, their patterns, or their emotional stability. And just like dating, a low number doesn't always mean high value. Sometimes it means desperation. Let's rewind to 2022. Bed Bath & Beyond had a low P/E. Meme investors rushed in. "It's undervalued," they screamed. But that number didn't tell the full story. Declining revenue, poor leadership, rising debt. Months later, the stock collapsed. The number was right. The context was missing. Meanwhile, companies like Costco and Apple might have had high P/E ratios, but their profits, customer loyalty, and brand power were rock solid. The market wasn't overpaying. It was simply acknowledging excellence. This is the danger of single metric thinking. We crave simplicity so badly, we cling to one number as gospel. But numbers without narrative are noise. Edward Ryan's method avoids this by stepping back. He doesn't treat the P/E like a golden compass. Instead, he sees it as one whisper in a room full of voices. You don't ignore it, but you don't bow to it either. Let's bring in a story. Tom, a retired mechanic from Michigan, was proud of buying cheap. Every time a stock dipped below a P/E of 10, he'd pounce. But his portfolio was littered with companies that looked good on paper and were rotting underneath. After losing 40% in a year, he took a new approach. He started combining his life list with the 3-signal scout screen and stopped using P/E as a decision maker. Within 2 years, he was back in the green. So here's a hard question. Have you ever bought a stock just because the PE looked low? Be honest. Because that mindset, while logical, is often rooted in fear. Fear of missing out on a deal, fear of overpaying. But investing isn't about fear, it's about vision. The PE can be useful, but only when supported by profit trends, brand strength, and debt awareness. Alone, it's like reading a blood pressure chart without knowing if the patient just ran a marathon. Let go of the illusion that one number can give you peace. Investing is not a magic formula. It's a living relationship with companies you believe in. And speaking of belief, there's one enemy of belief that's growing louder every year. An invisible force whispering in your ear every time you log in, scroll, or open the news. It's time to confront the noise. Chapter 8. The Noise Cancellation. Move. Every day you're under attack. Not by thieves or hackers, but by noise. Financial noise. Tweets shouting, "Buy now." YouTube thumbnails flashing fire emojis and 10x promises. A guy on TikTok in a rented Lambo screaming that if you're not in some obscure AI penny stock, you're already poor. It's chaos. And worse, it's designed to make you feel stupid, late, and desperate. But what if you could press mute? Let me introduce you to Jess. She was a 33-year-old nurse in New York. In 2023, she downloaded 6 investing apps, followed 20 creators, and joined a Discord for Crypto Alpha. For 6 months, her mood depended on charts. Her wins were erased by overreactions. Then one night, she stared at her screen and thought, "I've made investing more stressful than my job." That's when she went full noise cancellation. She deleted everything but one brokerage account. She removed price alerts, unfollowed finance influencers. She created her life list, applied the scout screen, and checked her investments once every quarter. And guess what? In 2025, her portfolio was outperforming most of the day traders she used to follow. Here's the uncomfortable truth. Noise is not just distracting. It's designed to override your strategy. Financial content is rewarded by engagement, not accuracy. That means creators are incentivized to make you feel anxious, reactive, urgent. They win when you doubt yourself. Edward Ryan's silent genius is this. His strategy creates peace, a rhythm, a quiet system you can follow, even while the world screams. You need to ask yourself, how much of your portfolio is built from conviction, and how much from tweets? Noise makes you forget your life list. Noise makes you second-guess your process. Noise creates a toxic belief. If it's not exciting, it's not working. But wealth isn't loud. It's subtle. It's patient. It grows quietly in the background, like a tree in a forest, not fireworks in the sky. Let's be honest, have you ever bought a stock you'd never heard of until someone hyped it online? Did it feel like a shortcut, a tip, a secret code? And did it work? Noise feeds your fear of missing out. But a real investor doesn't chase the next big thing. They build the next small thing, slowly, with intention. From now on, imagine your strategy like a quiet cabin in the woods. The noise is far away. Your checklist is taped to the wall. You sip coffee, review your life list, and make decisions from a place of peace, not panic. Because once you've silenced the world, you can finally hear yourself think. And once you can hear yourself think, you're ready to master the real battlefield, your emotions. Chapter 9. The Emotional Strategy. You can have the perfect portfolio, the best stocks, the simplest strategy. But if your emotions are out of control, none of it matters. Because investing isn't just logic, it's psychological warfare. And the enemy lives inside your own brain. Greed whispers, double down. It's going to the moon. Fear screams, sell everything, save yourself. Impatience pokes you when nothing happens. Regret drags you back to a trade you wish you took. And comparison, it poisons you every time a friend posts their crypto gains on Instagram. So, how do you fight back? Let me tell you about Arun, a software developer in San Diego. In 2021, he bought shares of Apple, Costco, and Tesla, all on his life list. But then Tesla dipped 30%. He panicked and sold. A month later, it soared. The regret was so sharp, he didn't invest again for a year. Then he did something brilliant. He stopped trying to feel good about investing. He built a rule book, a checklist, a set of emotional guardrails. Now, when his stocks fall, he doesn't react. He consults the system. He doesn't ask, "How do I feel?" He asks, "What does the checklist say?" Edward Ryan doesn't sell emotions, he sells clarity. But beneath his calm strategy is a deeper promise. When your emotions are managed, your wealth is unleashed. Your life list isn't just a stock list, it's a map of trust, and trust needs protection. Emotional discipline is that protection, because the market doesn't just test your strategy, it tests your identity. The key is this: decouple action from emotion. Feel everything, but do nothing until your process agrees. You're not here to be entertained, you're here to grow roots. Have you ever sold at the bottom just to stop the bleeding? Have you ever bought something simply because everyone else was making money? Those moments aren't shameful. They're human. But you don't need to be ruled by them. Create your own emotional strategy. Write rules when you're calm so you can follow them when you're not. And if the noise creeps back in, return to your life list. Remember why you chose those companies. Revisit your scout screen. Reset, rebuild, repeat. Because if you can master your feelings, you can master your fortune. And once your mindset is anchored, it's time to decide what kind of company deserves your long-term attention. Growth is great, but there's a trait even more powerful: consistency. Chapter 10. The Consistency Compounder. If growth is the spark, then consistency is the engine. It's easy to fall in love with explosive numbers. This company grew 300% last year. But fireworks always fade. The real wealth builders aren't meteors. They're metronomes. Quiet, predictable, relentless. Take a moment to think about this. Would you rather invest in a company that doubled once or one that grew 10% every year for 20 years? Most chase the first. The rich build wealth on the second. Let me introduce you to Kevin. He used to invest like a gambler. Bought Zoom during the pandemic, made $4,000 in a week, then lost it all in a biotech crash. Frustrated, he started studying what didn't crash. He noticed a strange pattern. Costco, Pepsi, Microsoft, McDonald's, none were flashy, but they had consistency. Year after year, they grew revenue, paid dividends, avoided drama. And over time, their share prices quietly compounded. So, Kevin made a new rule. He wouldn't invest in a company unless it had increased revenue and net income steadily for 5 years. That simple filter transformed everything. His account no longer spiked or collapsed. It climbed like a staircase made of granite. Edward Ryan doesn't say this directly, but it pulses through his strategy. Predictability is power. The companies on your life list that show up for you every day, those are your compounders. They don't seduce you, they support you. But consistency isn't sexy. That's why most people ignore it. They want drama. They want moonshots. But building wealth is like dating someone who texts back every time. No thrill, just trust. And trust builds empires. Think of it this way. Would you rather own a unicorn or a utility? The unicorn makes headlines. The utility pays your bills. And when the market crashes, the utility's still there, selling electricity, food, medicine. Real businesses solving real problems for real people. Here's a mirror moment. Are you addicted to excitement in your portfolio? Do you crave movement to feel progress? That's not investing. That's entertainment. And it's costing you. From now on, look for companies with 5 traits: steady revenue, positive cash flow, stable leadership, low debt, and recurring customer demand. They're not always obvious, but they're always effective. And once you've built this warehouse of reliable companies, you don't have to obsess over it. You don't need daily charts. You just need a place to store and protect them. Let's talk about what that warehouse looks like. Chapter 11. The Portfolio Warehouse. Imagine your portfolio not as a casino, not as a battlefield, but as a warehouse, a sacred space where only the most trusted products are stored. You don't let hype in here. You don't store junk. You store essentials, goods you'd bet your name on. This warehouse, it's not built for speed. It's built for safety, structure, and scalability. Most investors treat their portfolio like a shopping cart, piling in whatever looks shiny, throwing things out on impulse, forgetting what's even inside. But if your money is your future, then your portfolio should feel more like a vault than a vending machine. Let's look at Maya. She used to have over 40 stocks in her brokerage account, many of which she couldn't even remember buying. When a friend asked her what her portfolio strategy was, she replied, "Throw stuff at the wall and see what sticks." That answer haunted her, so she started fresh. Built a life list. filtered with the scout screen, focused only on businesses that showed 5-year consistency. And then she did something genius. She limited her portfolio to 10 positions, no more. Each one was chosen with care, like warehouse inventory. That shift made her treat investing like ownership, not speculation, and suddenly she felt peace. Edward Ryan's simplicity hints at this. Investing should feel boring, but powerful, like loading your warehouse with long-term allies who work for you while you sleep. Think of Apple. Every day they generate billions in revenue because millions of people trust them. When you own Apple, you're not hoping. It's already in motion. The same goes for Costco, Johnson & Johnson, Procter & Gamble. These aren't ideas. They're machines. Machines that live inside your warehouse and work on your behalf. Your job? Choose the machines. Maintain the space. Keep it clean. No clutter. No emotional clutter either. Here's the moment of self-reflection. Is your portfolio a warehouse or a junk drawer? Can you walk someone through each position and explain why it's there? If not, it's time to evict the noise and refill it with clarity. And here's where things get elegant. Once you've built this warehouse, you don't need to babysit it. You just need to check the shelves once a year. That's all. Not every week, not every crash. Just one annual reset. Because a good warehouse doesn't need daily drama. It needs maintenance, not micromanagement. Let's open the door to that ritual now. Chapter 12, the annual reset. Once a year, that's all it takes. Not every week. Not when CNBC says the sky is falling. Just one simple ritual, the annual reset. It's the heartbeat of a system that breathes longevity, not volatility. A moment of clarity in a year of chaos, a whisper amid the noise. The annual reset is not about picking new stocks. It's about asking, are my current teammates still performing? Just like a warehouse manager walks the floor and checks inventory, you, the investor, check your positions. Not with panic, but with purpose. Meet Elijah. Every January 1st, while his friends are hungover, he makes coffee and opens a spreadsheet. 1 tab, 10 stocks, his life list companies. He reviews the same 3 signals: profit, debt, shareholder return. If a company fails 2 out of 3, he reconsiders. If it passes, he holds. If it's borderline, he gives it another year. This ritual takes him less than an hour. And yet, over 5 years, it turned $15,000 into 38 thista with almost no stress. Why does this work? Because the power of investing isn't just what you hold. It's how long you hold it. And to hold something long-term, you need trust. The annual reset reaffirms the trust. Edward Ryan's brilliance isn't just his strategy. It's his refusal to let complexity steal your time. Investing should be like tending to a bonsai tree. A few mindful snips each year. Nothing wild. Just a careful trim, a quiet breath, a return to center. And here's the irony. Most investors think they're losing money by not checking their portfolios more often. But it's the constant checking that leads to tinkering. And tinkering is the enemy of compounding. The annual reset gives you freedom. You're not reacting to headlines. You're not dancing to Reddit's beat. You're running your own calendar. And in that calm, you create something Wall Street can't sell. Peace. So here's the reflection moment. Do you have a reset ritual, or are you just reacting? From now on, make this promise to yourself. 1 day a year, I check. 1 day, I adjust. The rest, I live my life. And here's the surprising part. When you start living like that, you start to invest like Warren Buffett, without the pressure, without the spotlight, just quiet excellence. Let's open the door to that idea next. Chapter 13, Buffett's Unseen Blueprint. You've heard his name 1,000 times. Warren Buffett, the Oracle of Omaha, the billionaire sage. But behind the headlines and shareholder letters, there's something deeper most people miss. Buffett doesn't chase. He waits. He doesn't trade. He owns. And the real secret, his strategy is astonishingly simple. So simple, it looks like yours. Buffett once said, "I only invest in businesses I understand." Sound familiar? That's your life list. Companies you already interact with, brands you trust, products you love. And he doesn't do 47-point technical analysis on them. He asks, do I trust the people? Do they generate profits? Can they survive storms? Let me share a story about a man named Ray, just a regular 40-year-old from Kansas. He read an old biography about Buffett and realized, wait, He's not picking magic stocks. He's picking obvious ones. So Ray took the Buffett blueprint and overlaid it on his own life. He chose companies like Apple, Visa, and Coca-Cola, not because they were undervalued, but because he used them every day and they passed his 3-signal screen. 10 years later, he hadn't beaten Buffett's returns, but he'd beaten almost every mutual fund manager in his area, without stress, without flair, just quiet mimicry. The insight Edward Ryan nudges us toward, without spelling it out, is this. You don't need to become Buffett. You just need to adopt his simplicity, discipline, and patience. Because the truth is, Buffett isn't operating on a different planet. He's doing what many of us refuse to do, ignoring the noise, trusting consistent businesses, and letting time work its magic. Here's the mirror. Do you admire Buffett's results, but reject his methods? Do you crave his calm while building your portfolio on chaos? What if you stopped idolizing Buffett and started mirroring him? Take fewer positions, hold longer, check less, trust your companies more, build a system that can survive boredom, not just brilliance. And once you do that, something amazing happens. You no longer feel like you need to watch the market every day. You no longer need to know. You've built a portfolio that grows even when you're not looking. That's what we explore next, how to let go and still win. Chapter 14, The Unplugged Advantage. The greatest advantage in modern investing isn't speed. It isn't knowledge. It's silence. In a world addicted to updates, charts, and dopamine-triggering price alerts, the investor who can unplug wins. Not just emotionally, financially. Imagine your portfolio as a garden. Every time you open the app, it's like digging up the soil to see if the roots are growing. Do that every day and nothing survives. But let it be. Trust the system. You'll come back to a tree bearing fruit. This is the story of Lian, a 29-year-old graphic designer in Singapore. She started investing during the tech boom of 2020. Checked her portfolio 3 times a day. Every up made her euphoric. Every down wrecked her mood. After 6 months, she realized she wasn't investing. She was emotionally gambling. So she set a rule. Only check your portfolio 4 times a year, once per quarter. She deleted the app from her phone, wrote her plan on paper, and set calendar reminders for her annual reset. 3 years later, her returns were solid, but that wasn't the real win. She got her life back. No more obsession, no more stress. Just quiet, compounding confidence. Edward Ryan may never have said it this bluntly, but it's baked into his system. If your strategy requires daily supervision, it's probably not a strategy. It's a distraction. Unplugging doesn't mean you're uninformed. It means you're unshaken. You don't flinch when headlines scream. You don't chase green candles or flee red ones. You are guided by your list, your signals, and your time horizon, not by emotion. Ask yourself now, how often do you check your account? Daily, weekly, and why? Has it ever made your decisions better? Or has it just made your nerves worse? Here's the truth most influencers won't tell you. Wealth doesn't grow because you're watching. It grows because you're not interfering. So, unplug. Let your companies work. Trust your warehouse. Walk away. Not from investing, but from obsession. Because when you unplug, you don't fall behind. You pull ahead. While others panic, you wait. While others overtrade, you underreact. And that underreaction, it's your superpower. Now that you've let go of constant noise, let's zoom in on focus. If you could only track 3 numbers, which ones would truly matter? That's where we go next. Chapter 15. The only 3 numbers that matter. In a sea of financial metrics, PE ratios, EVs, EBITDA, PA, PS, ROIC, RSI, it's easy to drown. But what if you could throw away the alphabet soup and focus on just 3 numbers? 3 signals so simple, so powerful, that everything else becomes noise. Here they are. Profitability. Is the company making money consistently? Debt load. Is the company's debt manageable relative to its income? Shareholder rewards. Is the company giving back through dividends or buybacks? That's it. These are the 3 pillars of a business that not only survives, but thrives. Let's look at a real example. In 2025, 2 companies dominate headlines: Hypetech AI and Costco. Hypetech just launched its 24th AI tool, has millions in revenue, but 0 profit and rising debt. Meanwhile, Costco quietly continues earning billions in net income, maintains modest debt, and returns capital to shareholders through regular dividends. Which one do you want in your portfolio warehouse? It's the same lesson Anna learned. She was a digital marketer who followed every finance YouTuber. Her spreadsheet had 27 metrics. She spent weekends analyzing stocks, yet her portfolio barely moved. She was working hard, but seeing little, until one day she erased everything and rebuilt from scratch. She asked, what would Warren Buffett care about? The answer led her to these 3 metrics. She applied them ruthlessly. Her stress disappeared. Her gains, however, finally appeared. Edward Ryan's system is genius because it forces clarity. You don't need to know everything. You just need to know what matters. Let's break each metric down. Profitability is the oxygen of a company. If it's not making money, it's not a business. It's a bet. Debt is a time bomb. Even good businesses can collapse if interest rates rise and debt piles up. Shareholder rewards prove alignment. If a company is confident in its future, it shares that confidence with you through dividends or buybacks. The market can distract you with noise. But these numbers, they whisper truth. They say, this company is stable, it's responsible, it respects its owners. So ask yourself, are you tracking metrics that make you feel smart or ones that make you wealthy? Because when you reduce the clutter, you create clarity, and clarity leads to confidence. Now, to apply this efficiently, you'll need tools, not complex ones, just the right ones. Let's step into the 2025 Toolkit. Chapter 16, the 2025 Simplicity Toolkit. In the past, investing required spreadsheets, financial news, Wall Street reports, and maybe a few gray hairs. Today, with the right tools, you can evaluate billion-dollar companies in under 10 minutes, on your phone, while waiting for your coffee. But here's the catch. Most people are using too many tools. They open 10 tabs, cross-check 10 metrics, get overwhelmed, and do nothing. Edward Ryan's method invites you to do the opposite. Strip it down. Use a few simple, powerful tools to automate clarity. Let's start with the essentials. 3 tools, 3 use cases. That's your new workflow. 1. Finbox, free tier or light plan. Your go-to for profitability and debt snapshots. You type in a company like Pepsi and instantly see 5-year profit margins, return on equity, and long-term debt versus EBITDA. It's clean, visual, and fast. 2. Simplywall, das ain't perfect for visual learners. It turns fundamentals into bubbles, graphs, and color-coded risks. More importantly, it shows dividend history, payout ratios, and whether the company has a record of rewarding shareholders. You're not just reading numbers, you're seeing the story. 3. Google Finance Plus AI Companion 2025 edition. It's no longer basic. Now powered with summarizing AI, it scans recent earnings calls, news sentiment, and presents a short, neutral digest. In 2 minutes, you know if there's trouble or just Twitter drama. Let me tell you about Karina. She's a freelance designer with zero finance background. She felt intimidated by investing, so she created her Power Hour routine. Every quarter, she logs into these 3 tools with her life list beside her. Each company gets a 3-minute check, profitable, low debt, still rewarding shareholders. If all yes, she holds. If not, she investigates deeper. That's it. No charts, no predictions. Just a digital coffee meeting with her portfolio. The beauty of the 2025 Toolkit isn't that it replaces your thinking. It amplifies your clarity. It removes the friction that leads to procrastination. And with Edward Ryan's simplicity-first approach, that friction was always the enemy. You don't need to act smarter. You need to remove the reasons you don't act at all. So ask yourself, are your tools serving your system or slowing you down? Because once you've set up your toolkit, everything else becomes muscle memory. Your life list, your screen, your metrics, all flowing together in a rhythm that works for you. And here's the truth you might not have realized yet. At this point, you're not just following a strategy anymore. You are the strategy. Let's make that explicit next. Chapter 17. You are the strategy. By now, you might be thinking, this system really works. But here's what you may not realize. You're not just using the strategy, you've become it. Because every company on your life list isn't random. It's a reflection of you. The brands you trust, the services you pay for, the routines you can't live without. They're more than habits. They're signals, data points, a mirror of your beliefs. You are already casting votes with your money. Now you're simply adding ownership to the equation. Edward Ryan laid the framework, but here's the deeper truth he hinted at. The greatest edge in the market is self-awareness. When you know your preferences, your values, your patterns, your portfolio becomes an extension of your identity. Let me introduce you to Jordan. No finance background, just a 32-year-old father who noticed he spent most of his monthly budget at Target, Spotify, and Disney+. So he wrote them down, researched them through the scout screen, and invested a small amount in each. But something strange happened after that. He cared more, not just about the companies, but about his own spending decisions. Owning a slice made him pay attention. And that attention, it became wealth. Because when your portfolio is built around what you actually use and believe in, you don't panic during dips. You don't sell when headlines scare you. You hold because it's personal, because it's real. Think about it. Have you ever bought into a company someone else recommended, only to feel disconnected and uncertain when it fell? Contrast that with a company you know, one that's been part of your life for years. That emotional connection becomes psychological armor. You are not just picking stocks, you are curating belief. This is what makes your portfolio unshakable, not complexity, not intelligence, but alignment. A perfect fit between who you are and where your money lives. And when that alignment locks in, something else happens. You stop chasing, you stop second-guessing, you trust yourself. The market becomes less of a mystery and more of a mirror. So, the question now isn't what should I invest in? It's who am I becoming through the way I invest? Because when your money reflects your life, and your life reflects your values, there is no separation. You and your strategy are one. And to prove how powerful this can be, let me show you what happens when someone starts with almost nothing, but applies this method, month after month, year after year. It's time for the $10,000 story. Chapter 18, the first 10,000 case study. It always feels like a mountain when you're at the base. $10,000? For many, it sounds impossible, especially if you're starting with just $100 a month. But that's exactly how the story begins. Meet Malik, 25 years old. Entry-level IT help desk job. Rent, bills, barely any leftover. But one night in 2022, after binge-watching finance videos and feeling overwhelmed, he stumbled across the idea. Invest in what you use. The simplicity hit him like a wave. He looked around. His laptop was HP. He drank Starbucks every day. His phone, iPhone, his shoes, Nike. That night, he started his life list. The next paycheck, he didn't try to conquer the market. He just bought $100 worth of Apple. No timing, no predictions, just one brick in the foundation. Every month after that, another 100 into a company he actually used, actually trusted. Over time, his routine became sacred. Life list, scout screen, buy. By 2025, Malik's portfolio had quietly passed $10,000. It wasn't magic, it wasn't fast, but it was real. He didn't win because he was smarter than the market. He won because he was aligned with it. He invested in companies that made his life better, and that loyalty, that relationship, paid him back. And here's what most people miss. That $10,000 wasn't just money. It was identity change. Malik wasn't just a consumer anymore. He was an owner. His confidence shifted. His decisions matured. He started seeing the world through an investor's lens. Edward Ryan's strategy made that possible, not by handing out stock picks, but by handing back control. The power to say, I know what to invest in because I know myself. Here's the mirror moment. Are you waiting to have more money before you begin? Waiting for the perfect moment, the bigger paycheck, the green light? The truth? You don't start with $10,000. You earn it through momentum, through belief, through repeating a simple act, month after month, until one day, the number in your account reflects the person you've become. You don't need brilliance. You need consistency. You need a life list, a checklist, and a few minutes a month. And once you embrace that, it's time to make your final upgrade. To look at the brands you've supported for years and finally ask yourself, why haven't I been profiting from my own loyalty? That question takes us to a deeper layer. Chapter 19, the loyalty loop. There's a silent loyalty contract we all sign, but rarely benefit from. You pay Apple every year for a new phone. You stream Netflix every week. You walk into Target for toothpaste and leave with a full cart. These brands don't have to convince you. You're already sold. You're loyal. But here's the twist. They're profiting from your loyalty. Are you? This is the essence of the loyalty loop. It's the recognition that you're already part of a business cycle. You just haven't claimed your reward. The moment you buy stock in a company you consistently support, the loop closes. Your role changes. You're no longer just a customer. You're an owner being paid for your own behavior. Let me tell you about Nicole. She was a mom of two, shopping at Walmart every Saturday. Her pantry was filled with products from Procter & Gamble, Tide, Pampers, Crest. One day, her 8-year-old asked, "Mom, do we own the company that makes this stuff?" That question hit her. She'd spent thousands over the years and never once thought of investing in those companies. That weekend, she started small, bought a few shares of Walmart, then PG, then Johnson & Johnson. Within a year, her dividends covered the cost of her family's toothpaste and paper towels. It felt poetic. She wasn't just spending anymore. She was circulating her money through businesses she believed in. Edward Ryan's strategy taps into this emotional loop, not just as a tactic, but as a philosophy. When your money reflects your daily decisions, you create a closed ecosystem of trust and return. So here's your mirror. Where does your money go every month? Which companies could send you a thank you note for your lifetime of loyalty? Now, imagine receiving that thank you in the form of dividends, share price appreciation, ownership. Because when you invest in what you use, you invest in what you already understand. That removes fear. That creates patience. That fuels the loop. And that loop, once it's complete, investing no longer feels like gambling. It feels like coming home. So take inventory of your wallet, your subscriptions, your routines, then ask, which of these companies do I believe in enough to own? Because in the next chapter, we'll explore the final transformation. Saying goodbye, not just to bad stocks, but to the emotions that drive bad decisions. It's time to break up with FOMO. Chapter 20, The Farewell to FOMO. It starts as a whisper, a tweet, a headline, a friend saying, "Bro, did you see this stock?" Then it grows louder, charts flying, arrows soaring, comments exploding with emojis. And suddenly, you feel it, that familiar heat in your chest. FOMO. Fear of missing out has ruined more portfolios than bad companies ever could. It's not a market force, it's a mental virus. And to build lasting wealth, you must do something radical. You must break up with it. Let me take you into Sam's story. A 31-year-old school teacher who'd been investing steadily for years. He built a portfolio of Costco, Visa, and Microsoft, all on his life list. But one day in 2024, a new EV stock went viral. Everyone on Reddit was calling it the next Tesla. Sam resisted at first, but the noise grew louder, so he caved, sold half his Microsoft stake, and bought into the hype. 3 weeks later, the stock crashed 80%. The founders were under investigation. Sam wasn't just broke, he was heartbroken. Not because of the money, but because he had betrayed his own system. FOMO doesn't just rob your wallet, it robs your confidence. Edward Ryan's entire philosophy exists to immunize you against this disease. Because when you have a life list, a simple scout screen, a clear set of metrics, and a warehouse of companies you understand, you no longer need FOMO. You've outgrown it. And here's the deeper truth. FOMO is powered by insecurity. It thrives when you don't trust your process. But once you do, it dies. The market will always have a new darling, the next unmissable opportunity. But remember, you're not missing anything. You're building something. Quietly, patiently, intentionally. So ask yourself, how many poor decisions have come from feeling left behind? How many times did you chase a rocket only to crash into the dirt? It's time to draw the line. From today forward, you don't invest because something is loud. You invest because something is aligned. You don't follow crowds. You follow clarity. You're not just escaping FOMO. You're evolving into a strategist, a builder, an investor who trusts their rhythm more than someone else's chaos. This is your farewell letter, not to risk, but to reactivity, not to ambition, but to addiction. You don't need hype, you have a map. And now that the noise has quieted, now that you've simplified, clarified, and personalized your strategy, it's time to close the loop. Let's wrap it all together. Take a breath. Look back. In the past few minutes, you haven't just learned a strategy, you've experienced a transformation. You've gone from spectator to strategist, from someone chasing tips to someone following trust. Let's reflect on what you now know. You discovered that the secret to stock picking isn't in Wall Street, it's in your shopping cart. You built a life list, your own mirror of loyalty, trust, and daily habits. You learned the Scout screen, profitability, low debt, shareholder return. You let go of complexity, noise, and obsession, and embraced a simple, repeatable rhythm. You realized you don't need to be Warren Buffett to think like him. You saw how tools, not talent, create traction. You understood that the only 3 numbers that matter are the ones that reveal strength. You became the strategy, and most importantly, you said goodbye to FOMO. Forever. But here's the real question. Will you let this wisdom gather dust, or will you act? Right now, I want you to do 2 things. What's one company you've used for years, but never thought to invest in? Your grocery cart champion, write it down. Not because you need another video, but because this channel is a movement, a quiet rebellion against noise, hype, and complexity. Together, we're rewriting what investing looks like, for real people, with real lives and real goals. Remember, you don't have to find the next big thing. You just have to notice the things that never left your side. Your life is the watch list. Your habits are the compass. Your trust is the strategy. Let's build wealth, one quiet decision at a time.